You won't believe this about Amazon stock. Woo, this is nuts. Nuts. All right, so we're going to go to LouRockwell.com, anti-state, anti-war, pro-market, and David Stockman. And you may or may not remember David Stockman, but we can click on his link and look for Pablo and his bio. Well, I guess that's just all his articles. Hold on. So there's David Stockman. Is an American politician and former businessman who was a Republican U.S. rep in the state of Michigan and the old director of Reagan's OMB, Office of Management and Budget. And he left Reagan's office pretty ceremoniously because he took issue with the spending policies. Anyway, so we're going to talk about Amazon stock. Wokester capitalism, Jeff Bezos style. Stay with me here. I'm telling you, because there is some serious nuggets of info that you got to know. I'm sorry, there's a kind of free market conservative, John Timney comes to mind, that somehow thinks massive fiscal and monetary insanity emanating from Washington happens in a vacuum, and that as lamentable as that may be, it doesn't gainsay the brilliant works of today's corporate titans in Silicon Valley. So never fear, capitalism dynamism will out. Boom times lie ahead regardless of the trolls and grifters who occupy the nation's seats of power and the endless cockamamie schemes and assaults on the free market they generate. Oh, we beg to differ. By and large, these new titans are not geniuses. They are bubble riders who were in the right place at the right time. After years of the Federal's massive inflation of financial asset prices, they have become totally corrupted, politically, intellectually, and otherwise. We are put in mind of this baleful reality by today's headline announcing that Jeff Bezos is foursquare behind Sniffy Joe's infrastructure abomination, including its massive tax hikes. Bezos says he supports a rise in the corporate tax rate and supports Biden's focus on major U.S. infrastructure spending. We recognize this investment will require concessions from all sides. He said Amazon was supportive of a rise in the corporate tax rate, and he said the company looked forward to seeing the U.S. government's progress on the plan. We could say this is just another incarnation of Lenin's famous quip that the capitalists will gladly sell you the rope to hang them with, but actually it's much deeper. These people have been made so insanely rich by the Fed's egregious stock market inflation they no longer care if their businesses are inconvenienced or even deeply harmed by schemes like the Biden tax hikes. And worse, they have no idea how real sustainable wealth is generated or that free market prosperity is not all a sure thing when the state becomes an unhinged wrecker of honest money. In the case of Bezos, the chart below tells you all you need to know. Let's see what the chart is right here. All right, so see that's Amazon's market cap. All right, here's their free cash flow. There's their market cap. There's their free cash flow. All right, let's read what that means. All right, the chart below, right here. All right. At the end of 2015, the company's market cap stood at $315 billion, making Bezos fabulously wealthy at $45 billion. 5 years and the most costly divorce in the history of the planet, Bezos is worth $175 billion. Needless to say, 5 years ago, Amazon was already absurdly valued at 47 times the company's modest free cash flow. That is, on $107 billion of sales, it only brought in $6.7 billion to the bottom line, which is operating free cash flow, owing to the massive levels of CapEx, capital expenditures, marketing, and operational spending. The chart below leaves no doubt what has happened since then. And let's go look. The company's market cap has boomed while the free cash flow has not. All right. The company's market cap is now at $1.6 trillion, or has increased by 5.2 times. By contrast, operating free cash flow has only risen by 3.9. Consequently, the company's free cash flow multiple has erupted to an outworldly 63 times. So before it was 47 times, which is high, and now it's 63. And we do mean otherworldly. Amazon is a 30-year-old company that's coming off the COVID year of the perfect storm for a monster e-commerce retailer. A COVID lockdown-stricken population cowering in their homes, ordering front door delivery of goods and supplies like no time in history. Net sales during 2020, listen to this, net sales in 2020 had risen by the incredible sum of $106 billion net sales. Just net sales had risen last year by 106 billion. Let's put that in perspective. That 1 year gain exceeded the total sales of the nation's second largest retailer, Target. Did you hear that? The growth in net sales exceeded that of the nation's second largest retailer. Not just the growth, the total sales. That's right. With 1,897 stores occupying 250 million square feet of space, Target posted annual sales of $93 billion, which had taken the company more than 50 years to achieve. And yet that sales level will be less than Amazon's 1 year gain during the pandemic. I mean, that's just freaking nuts. Still, no one in their right mind would expect 2020's, whatever that is, sales growth to continue. A vaccinated public has had enough of cardboard boxes on their front doorsteps and is more than ready to break COVID jail. I don't know, man. I think the vaccinated public is still scared. They're still scared. I'm telling you, man, it's the weirdest thing. So to value a $386 billion sales behemoth at 63 times a once in 100 years flood tide level of free cash flow is lunatic. So it's already trading at huge records of free cash flow. To value that after a once in 100 years flood tide is, well, its increase is more than Target's, which is number 2, whole sales. On the other hand, with $24 billion of pre-tax income in 2020 and an infinitely speculative and global stock market, Bezos apparently figures that throwing the rest of corporate America under the tax bus is worth it, because they'll buy him protection from Sniffy Joe. Even that's not all. Amazon is not merely absurdly overvalued, it's also an unhinged menace on the economic highways and byways of Main Street America. Yes, we get that bit about Amazon being a boon to customers, but low costs earned in the marketplace based on reasonable return to capital is one thing. Predatory pricing without regard to profit in order to simply conquer new market segments is something different. In a word, the latter doesn't happen for long on an honest free market because predatory loss makers soon run out of access to investment capital, and without capital to subsidize losses, the predator's business model leads to failure. As it happens, the Fed and Wall Street Casino has fostered the Fed and the Wall Street Casino it has fostered has made predatory capitalism viable in violation of the laws of economics. That is to say, Amazon's e-commerce business is so ridiculously overvalued that it actually is paying Bezos and his minions to dissipate free cash flow on loss-making ventures of every shape and size. I cannot stress this enough. Amazon's e-commerce business is so ridiculously overvalued that basically Bezos has so much money he doesn't know what to do with. Which is kind of like a mutual fund that invests in who has too much money coming in. Like, I don't want to buy this stock. I don't want to buy it, but I got to do something. I got all this money coming in. The same thing why you don't want to chase past performers, because they just get flooded with cash they don't know what to do with. So Bezos and his minions to dissipate free cash flow on tons of loss-making ventures. The truth is obscured by the fact that Amazon's meager profitability from its core e-commerce business is supplemented massively by its wholly unrelated cloud services business called AWS. Thus, during the record e-commerce of 2020, AWS still accounted for nearly 60% of Amazon's operating profit based on just 11.7% of its total sales. Does that make sense? It's the 80-20 rule. The Pareto rule. 80% of your profits come from 20% of your clients. AWS accounted for nearly 60% of Amazon's operating profit on just less than 12% of its total sales. Stated differently, Amazon's operating margin at AWS was 29.4% versus just 2.7% of its giant e-commerce business. At the bottom line, therefore, AWS earned net income of approximately $12.6 billion. If you were to value AWS at Microsoft's price to earnings of 37, its standalone market cap would be about $470 billion. That's more than fair. During the last 3 years, Microsoft operating income has soared from $4 billion to $23 billion, or by 5.6 times on the strength of its belated takeoff of its cloud business. By contrast, after several years of triple-digit operating income growth prior to 2017, AWS Operating income rose from a nearly identical 4.3 billion in 2017 to just 13.5 in 2020. That's a gain of 3.1 times, which is sharply below the Microsoft figure. At the same time, Amazon is currently valued at 1.6 trillion, which implies the e-commerce business, including advertising, is worth 1.14 trillion, 1.15 trillion. Then again, the net income attributable to e-commerce business in 2020 was just 8.7, which puts it at 132 price-earnings ratio. That's truly out of this world because Amazon's 2020 fueled COVID. E-commerce earnings were wholly aberrant based on its massive 96 billion volume gain in the segment. Which is no wonder why Bezos is all, yeah, tax my competitors, tax, tax, tax. Don't tax you, don't tax me, tax that guy behind the tree. By contrast, the e-commerce segment net income was only half of 2020's in 2019. In short, the effect of a massive overvaluation of the Wall Street casino is that Amazon's management is giving seriously erroneous signals. During the last 5 years, it has not paid a dime of dividends or bought back a single share of stock despite generating nearly 1.72 billion of cash flow and 300 of gross profits. What this means is that Amazon is using these enormous flows to flood the marketplace with below-cost pricing and loss-making ventures and endless new segments while pleasuring Bezos and his public stockholders with an endlessly rising share price. As we have often observed, there's no more dangerous combination than free money and free markets. Together, they have turned a once and former Schumpeterian entrepreneur into a hideously rich destroyer of Main Street wealth, even after he offers Sniffy Joe the rope to which to strangle what remains of sustainable capitalist prosperity. At the moment, of course, conservatives and Republicans are bewailing the embrace of Bezos and his corporate ilk of what amounts to a state religion of wokedom, with the latest examples of Major League Baseball and Coke and all that. But do they suppose that after a near-death experience in 2020 and 12.4 billion of losses, that Delta Airlines would be trading at near record cap of 32 billion had not the Fed flooded the market with fiat credit? Or that after 10 straight years of negative net income growth, Coca-Cola would be trading at nearly 30 times net? Indeed, the chart below tells you all you need to know. Thanks to Mad Money printers in the Eclipse building, Coke's market cap has soared from 150 billion to 220 billion in the last 10 years, even though its net income has plunged by nearly 40%. At the end of the day, Coke's now very woke executives got very rich, but not because of the company's miserable performance. They got rich and woke because the Fed made it so, fueling a rampant gambling casino on Wall Street that took the company's PE from 12, which it barely deserved, to nearly 30, which is a pure crime upon honest finance. Still, the Republicans are prescient, but still, are the Republicans prescient enough to see that the real enemy is the central bankers who have enabled these wokester capitalists become so unspeakably rich they no longer even need to pay attention to business or challenge the Wall Street politicians who threaten it? The answer is unfortunately no. As we addressed these same overvaluations during an interview on the outlook for post-COVID economy, with the passage of time, the threat from Washington has only metasized measurably, even as the bubble has continued to swell. Yeah, look, it's 100% true. I don't know what to. So what do you do about it? I mean, I don't know. Well, that's a problem. What do you do? I don't think you buy Amazon. That's for doggone sure. Let's see. Just look at the PE. Let's see what the PE of the whole company is. Let's take a Gantt. Oops, that's our weather. I don't want the weather. Let's see what the PE of Amazon is right now. 80.62, which is still a nosebleeder. But you take out the AWS thing, it's what he said, 132. I just throw up my hands in awe and wonder how bad it's going to be when the market falls, because this is you got to make money, man. And it's not shocking at all that the companies, the winners, are calling for tax rates on their competitors. That's just what this is, man. All right, we'll see. I'd love to hear your thoughts.